Do you remember Domino's Pizza? It was a darling of the ASX for many years, growing rapidly and seemingly immune to economic conditions. But now, it's a shell of its former self. So what happened?
Alice.
Let's investigate. The first red flag appeared in November 2024, when leadership and strategic disruption announced that Carrie Hayman would resign as CEO after just 9 months in the role. Now, in fairness, she inherited a tough situation. The company had been buffeted by years of instability, including a store credit card scandal in 2021, supply chain disruptions during COVID, and changing consumer behavior. However, given her lack of retail experience, investors were already jittery about her ability to turn things around. The hasty exit only amplified these concerns, creating a leadership vacuum at a critical time. Shortly after, Domino's announced the closure of 205 underperforming stores globally, with a whopping 172 of those located in Japan. This move sent shockwaves through the market, signaling an aggressive scale-back and hinting at significant earnings strain. The company admitted that the restructuring would result in a one-off cost of approximately $10 million. It's primarily driven by lease incentives to terminate unprofitable store agreements. In January 2025, Domino's released its half-year results for the first half of financial year 2025. And to put it bluntly, they were dismal. Network sales dropped by approximately 2.9% compared to the prior corresponding period. Same-store sales, a key metric for measuring organic growth, declined by 0.6%. And earnings before interest and tax fell by 6.7% year-on-year. To make matters worse, earnings per share have been on a downward spiral, plummeting by 32% annually over the past 3 years. Naturally, the stock price has mirrored these poor performance figures, sinking by roughly 26% annually over the same period. Despite these challenges, Domino's management remained optimistic, projecting an improvement in sales and earnings in the second half of the financial year. Adding to the chorus of pessimism, Morgan Stanley downgraded Domino's target price from $110 to just $20, citing concerns about shifting consumer preferences and increased competition. This negative sentiment culminated in Domino's removal from the ASX 100 in March 2025, a notable index that tracks the 100 largest companies in Australia. This demotion, while not a reflection of the company's absolute size, is a clear indicator of the market's waning confidence in Domino's Pizza Enterprises. As if the preceding events weren't alarming enough, broker downgrades by heavyweights like Goldman Sachs, UBS, and Morgan Stanley pushed the stock to the brink, sending a clear signal to the market. When heavyweights like BlackRock and Vanguard start exiting, it creates a domino effect, so to speak. Ingredients, labor, packaging, and other crucial inputs are all feeling the heat of inflation. With more people opting for healthier, cheaper alternatives or simply eating out less, Domino's is finding it harder to entice customers. This is particularly evident in Asia and Europe, where consumers are more health-conscious and have more diverse food options available to them. This squeezes profit margins, eats into earnings, and leaves less money for reinvestment and growth. Meanwhile, Domino's pizza rivals are stepping up their game, innovating with new menu items, delivery models, and marketing campaigns. Its network-wide sales, although temporarily dented by external factors, have a history of resilience and growth. The company's focus on innovation, international expansion, and digital transformation, coupled with its solid financial position, suggests that it is well equipped to navigate the challenges ahead. All of this is happening in an environment where consumer budgets are stretched, forcing consumers to be more discerning about their spending. Other institutions follow suit, further depressing the stock price, and it's a vicious cycle. The price keeps falling, which prompts more selling, which further drives down the price. These institutions were trimming their positions, further deepening the bearish sentiment surrounding the company. They might see the stock price plummeting and assume it's time to sell, further exacerbating the problem. Looking at the bigger picture, institutions collectively own about 58% of the stock, but there's more. Individual investors, often unsavvy about the inner workings of the stock market, tend to be swept up in this tide. Now let's talk about Domino's financials. While the company's debt levels are not crippling, sitting at around $380 million, this burden is substantial, considering its current annual interest payments stand at about $50 million. This translates to a debt-to-EBITDA ratio of 4.2, a figure that would certainly raise eyebrows among investors concerned about financial risk. Moreover, the issue of high input costs continues to be a thorn in Domino's side. But it's not just about the financials. Changing consumer preferences are also posing a serious challenge. And let's not forget the competitive pressures. Uber Eats and other delivery platforms have matured, offering more efficient services and enticing customers with discounts and promotions. So what's the takeaway here? Despite some short-term pain, Domino's fundamentals remain strong, and its long-term prospects are bright.